You might be faced with a scenario when placing a pairs trade where one asset is way more volatile than the other, and the trade could very easily move against you. And so how do you manage your risk? Well, one way to do that is to look at the volatility of the two assets. And so today we're going to look at modeling volatility using GARCH models so that we can decide, for example, how much of my capital I want to allocate to Bitcoin versus Ethereum to manage that level of risk. So let's look at the returns of Ethereum here graphed over time. Now you can see that here we have these clusters where the returns are really high and low. They spike a lot. So these sort of high volatility periods going on. And you can see that they clustered together. And this is over a period of, say, about 5 years. So here we have this volatility cluster here of a period of high volatility. We have it here as well. We have it here. And then, of course, in other areas, we have lower volatility as well. If I look down at the chart here, this is an actual volatility chart of Ethereum. You can see that at times we, of course, have these huge spikes. But volatility isn't just doing this. It's not just going up and down. It's clustering over time. We have these periods where it might be low for a period and then, spike up, and then that volatility might continue for some time. So how do we actually model this behavior? Well, the good news is I know that the prior videos have been very heavy going, but you've now done the work to lay the foundation so that you can further understand how to model, for example, today, volatility. GARCH stands for General Autoregressive Conditional Heteroskedasticity, and I know that's a heck of a lot to try to get your head around. What does that all mean? Let's just start quickly with the elephant in the room. Heteroskedasticity. Well, usually with our data, we like to work with what's known as homoskedastic data. And this really just means that the variance doesn't change over our sample. It's consistent over our sample, and in our case, that means over time. So if our data on a graph is, say, spreading out over time, we would say that's actually heteroskedastic. And ordinary least squares models don't deal very well with that at all. So already you can probably understand that here we're going to use maximum likelihood estimation to estimate the parameters of a given model, just like we covered in the last video. But we don't need to go through all that math again. We're just going to build it in Excel pretty quickly. These volatile periods that we've just been talking about, where we have these clusters of volatility, are exactly what we want to model. So we expect that our data is heteroskedastic. We can see that from the returns here. We can see these volatility clusters that we've just spoken about. And so we need to use maximum likelihood estimation, number one. Number two, it's that exact volatility we want to measure in the first place. Now, I've used the word volatility a lot. What actually is volatility? Well, really, it's just the annualized standard deviation of some or other model. And I'm going to talk about and model with you different types of volatility here in this video. And so where does standard deviation come from? Well, that comes from our variance. So really what we're doing here with a GARCH model is we're going to model our variance. Very quick deep dive. Here's what that formula will look like. Our variance at whatever time, which will be equal to some constant. Here I'm just going to call that omega, plus some proportion of the prior time period's market shock. And I'll talk about that market shock in a minute. Plus some proportion, which I'll call beta here, of the prior time period's variance. Now let's just take a moment to think about this prior time period's variance. We're looking at some proportion of that. What that means is that prior period's variance, we're expecting it to linger around, and we want to know by how much, because we know that volatility here clusters, or let me just say, in this context, variance is clustered and it might be influenced by the prior time step. Well, this model takes that into account. This model here for a GARCH model, by the way, is known as a standard symmetric GARCH model. And there are more powerful, better GARCH models out there like eGARCH. In the future, if you want me to cover them, just ask in the comments. I'll be happy to do that. But for now, I just want to get across the basic principle, and so I don't want to overcomplicate things. So we can see at the end here, we're going to retain some of the impact from the last period's volatility in this particular model here that we're building, plus some proportion of the market shock. Now, what do I mean by that? Well, we can model the market shock however we want to, now that we've gone through these videos that we have in this series. But here we're going to keep it really simple. We're going to model it as just the current period's returns versus what the average returns are, or the expected return, which we're going to model as the average. So that's just going to be the return R minus R bar, which means, the average of the returns. So we'll call that our market shock. So really what we're trying to do is figure out how long do market shocks persist for here in our model, and also how does the variance persist as well. So how does the volatility behave? Is it highly persistent? Does it sort of stick around, or does it go away quite quickly? And if you think about it, we really need our variance to stay positive. We can't have a negative variance. So these coefficients over here and this omega, this fixed value, they're going to need to be positive numbers. And so we're going to force them to be positive numbers in our modeling as well. Now, the log likelihood formula, I'm not going to go through deriving this, but here is the formula that we're going to be using to build our log likelihood, which is what we need to fit the best curve possible to our data so that we know we've optimized for the best parameters possible. And so this is what we're going to use for maximum likelihood estimation. So here's the data. We've got Bitcoin and Ethereum, 5 years worth of data here going up until around the 11th of June 2024. Of course, I pulled this data from Crypto Wizards. You can pull it from wherever you want to for any assets you want to. And let's start by modeling Ethereum first and foremost. So here I'm just going to magnify this so you can see things a bit better. And let's go and link to our Ethereum data here. And I'm going to drag that down as well. Let's format that. And here is my Ethereum price data. I'm just going to do some formatting here to neaten things up. And let's put in our returns as well. So this is just going to be, in fact, we're going to use log returns. So logarithm of this value divided by this value. And there are our log returns. So I'm going to drop that down as well. And I'm going to format that again as a number that looks like this. And in fact, I'm going to put the average returns up here. I'm going to change the color of the cell so I know this is actually a formula and it works differently to the other cells. And that's just going to be the average of our returns. And just to help us out with our spreadsheet, here are the formulas of what we're modeling. We do need our average return here, which is what we just built there, and our returns to model market shocks. And in fact, let's do that. We're going to need our market shock squared. We know we're going to need a column for that. So here I'm just going to call that E with a caret 2 to show that it's our market shock at whatever time squared. And I'm going to model that as follows. That's going to be the return, which is this number here, minus the average. Great. And then let's just drop that down and also break those decimals out as well. Also, this number needs to be squared based on the formula. So I'm going to put some brackets around it and put caret 2 to square that number. Now we need to model our variance, which is this number here and also this number here. Same column, just different time periods that it's looking at. So how are we going to do that? Well, we have the formula for the variance, but we just don't know what these coefficients are yet. So we're going to make them up. We're going to just approximate them to start with and get some initial sort of values in, and then use optimization and maximum likelihood estimation to do all the computing and hard work for us to figure out what those values actually are. And so these are the values I'm going to be working with: omega, alpha, and beta. And I'm setting this to 0.001. The number, remember, needs to be greater than 0. Same for these ones here. Alpha 0.1, beta 0.5, and then alpha plus beta is just going to be a formula. This number, alpha plus beta, needs to be kept less than 1. I'm going to show you why this alpha plus beta comes in handy in a moment once we've done our estimation. Now let's just model our S squared, our variance over here, which again is this part of our formula. And remember, that's going to be equal to our omega over here plus alpha times the prior period's market shock over there, because that's sub t minus 1, so that's the prior period, plus beta times the prior period's variance, which is actually just going to be above here because it's going to come from itself, right? So this is a column of the variance. We're going to reference it to itself in the prior period. And I'm only going to fix that there to the column. Now, actually, this is going to be the formula that we'll start at this cell here because we need some kind of starting variance number. Then I'm going to assume that market shock is the first variance that we have in our data set. So because this is at, let's say, time 1 over here, I'm going to move that there and just assume that the variance is the market shock. So another way to show that would just be to make that equal to the market shock there as our starting variance. Great. Now let's drop this down over here. Perfect. And let me move these formulas out of the way here a second. And because we're going to be working with the log likelihood, let me just bring that up here so we can see exactly what's going on. So this here is going to be the likelihood sigma part of this formula. So because we need to sum a bunch of rows, we need to build this part here of the formula. And that very simply, I'm going to do it from here. That's going to be equal to the logarithm of our variance, which is our sigma squared at times t. So there it is there. Plus our market shock over our standard deviation, which is the square root of the variance, squared. Well, that's the same thing as this squared divided by this squared. It's the same thing, which I already have. So that's going to be this here divided by this here. Perfect. And let's drop that down over there. So there's my likelihood function. And then what I'm going to need here, I'm just going to copy this for formatting. And I'm going to make this, say, a darker blue. So I know this is going to be my likelihood. Let me move it up there, actually. Change the formatting of that. And let's call this our log likelihood, which is going to be equal to minus a half. So minus 0.5 times, which is this part of the formula there, minus a half, times the sum of this entire column here. And I'm going to just hit enter there. So that gives us this number there. I'm going to put that to, say, 2 decimal places. And there we go. Let's move this out a little bit there. Now let's actually set this up for estimation. And having some initial values in here is quite important. Just put it approximately to what you think it might be. Just it can be very, very ballpark. But I would suggest with going with some initial values like what I've got up here. So now we're going to do our estimation part. Let's go up here to Solver, Data Solver on Excel. And we're going to say, look, I want to maximize this cell over here, the log likelihood, because if I maximize that, the highest value possible, based on changing these cells here, so I'm going to link to those, then I'll know those cells are their optimum values. So that's what I'm going to do. If none of that makes sense, the prior video on maximum likelihood estimation goes in this in ridiculous detail. So please feel free to watch that if you haven't seen that. Now let's go and add in our conditions. So I know that I want this to be greater than 0. And in fact, I want to put here a very small number, which we can write as 1e-19. That means 0.1901. That's a very, very small number. So I'm going to put that in here. And I'm going to add another condition, which is going to be this one over here. And that is going to be greater or equal to, I'm going to put in here 1e. And again, a very small number. I only need about 50. I don't even probably need that many decimals here, but I'm going to do that. And then here I'm going to add another one. Sorry, it's popping up on my other screen. This one here, greater or equal to, again, 1e15. Fine. And then finally, the next one we want to add is this a plus b. This should be less than 1. So I want to add that. And that's going to be alpha plus beta, I should say. Should be less than or equal to 0. I don't know how many 9s. I could have done the whole 9e thing, but this is how I'm going to write it. And there we go. It's got to be less than 1. Now let's go ahead and click solve and see if it can find the optimum parameters. Okay, it's working over here. It's flashing at me. And you can see the numbers changing here live. And they look like they're converging to some fairly reasonable numbers. This looks good to me. Now let's hit OK. So what is this telling us first and foremost? And then what analysis can we do from here? Well, first of all, we have our constant, which we can see is a very, very small number. And our reaction to the market shock is 0.08. So for every, let's say, point that return is varying from its average, which is how we've modeled our market shock, then the volatility is retaining about 0.08 of that market shock. And then this number here, this is a very interesting one, the beta, because this here is the proportion of the prior period's volatility. How much of that is hanging around? Well, 0.8991 is basically 0.9. It's a fairly high number. So the volatility here is rather persistent. It's hanging around for a fair while. So how do I calculate actual volatility? Well, let's go and do that over here. I'm going to actually just insert a column and get rid of that. Let's call this GARCH volatility. GARCH vol. Let's call it that. I'm going to want the number of trading days. I'm just going to copy this cell over here, pop it down there. I'm going to change the color of this to, I don't know, I like orange for this sort of thing. And there's about 365 days a year for trading Bitcoin and Ethereum. If you were trading, say, stocks or doing this for stocks, you might use 250 or 252 days. So here we're going to use 365. We don't need the decimal places there. And now let's calculate our volatility. That we can get very simply by taking our variance, multiplying it here by 365 days, and taking the square root of that. That number there is our annualized volatility. So I'm going to drop that down and put that as a percent. So you can see here that is 84.1%, 89%, etc. And now if I go and graph this, so if I go and highlight all of that and show you what it looks like graphically, here you can see Ethereum's volatility over the last 5 years. I'm going to delete that graph for now. We'll come back and build it again. But I just wanted to show you what it is you need to do in order to see the volatility over time. Well, now you've calculated volatility over time. What volatility number does this model average out at? What does it sort of revert to over time? Let's call that our long-term volatility. In fact, I'm going to move this down here, and I'm going to call this, first of all, our long-term variance. Let's work out what that number is and change the formatting here to be Calibri, so our long-term variance. And there's a special formula we can use for the standard symmetric GARCH model, which is going to be our omega over here, divided by, and then in brackets, 1 minus alpha plus beta. And so our long-term variance is actually this number, but it's not very meaningful to us. We're used to talking in sort of annual volatility speak and percentage terms. So let me help you out with that there. So first of all, to talk about this as a long-term volatility, which is not annualized, I would just say the square root of the variance, because as you're now very quickly learning, volatility is really the standard deviation. How much this asset is moving around its mean, how much it's deviating around its mean. So the square root of the variance is really the volatility. So here, this is 4.9% each period, in this case, each day. And so the annual long-term, or what we also call the unconditional volatility. This unconditional volatility is that average volatility that the GARCH model is sort of moving around. That's there going to be equal to the square root, which is going to be this long-term variance multiplied by 365. Let me close the brackets there. And we can see that the overall average volatility, let's think of it as that over this long period of time, for Ethereum is 94.2%. So in fact, what I'm going to do here is I'm just going to call this our unconditional volatility. And that's equal to this 94.2% over here. I'm just going to drag that down. So let's actually go and graph this. I'm going to go and create our line graph of these guys here. We'll call this Ethereum volatility. What is the actual standard deviation of our returns in volatility terms, so annualized volatility? Well, we can look at that as well. I'm just going to call that our historical volatility. And that is going to be the entire data set, not just our annualized one. So we need the sample standard deviation, so standard dev.s. I'm going to highlight all of those cells over there. So that's the standard deviation. We could leave it here, but that's not our volatility number yet. We're going to take that, multiply it by, to give it its annualized value, the square root of this number over here, the log likelihood. And there we go. So we've got our standard deviation times our annualized value. And I'm calling this the log likelihood. Sorry, this here is our trading days. And I can't believe I've left that saying log likelihood this whole time. That's a complete error on my part. This is trading days, annual trading days. I should have changed the name. Hopefully I described it more accurately earlier. So sorry if that confused you. Totally my fault. And there we go. We've got our historical volatility over here, 84.0% over the entire data set. Now, I told you that we wanted to do a pairs trade. So I wanted to know how much capital should I allocate to each asset. I've only looked at this for Ethereum. So what we're going to do here is just create a copy of this sheet here. I'm going to create a copy. And I'm going to call this one here Bitcoin, BTC. And here we're going to use Bitcoin's data. So that's going to be column B1 that looks up. And this one over here, column B1. And I'm going to drop that down. So now I have Bitcoin's pricing here. This is not going to be ETH volatility. This here is going to be BTC. And actually, as a proxy, I'm going to leave in the Ethereum numbers as a starting point for this maximum likelihood estimation. So let me just bring this graph down here for now, out of the way. And let's go and run our maximum likelihood estimation. So here I'm going to go solver. And luckily, it's remembered all the same settings over here because we created a copy of the sheet. But now let's go and click solve and have this run for Bitcoin. So once the model's built, you can see it's really quick and easy for us to actually just go and run the MLE. Perfect. That looks to be done. Let me just hit OK here. Bitcoin over time has had one extreme volatility or period of volatility at 350%, but its historical volatility is 68% versus Ethereum, which was 84%, and its annual unconditional long-term volatility is 85% versus Ethereum, which is 94.2%. So we can see that Ethereum is the more volatile asset here, which may or may not be a surprise to you. Let's also put in here the latest. So the latest volatility number, and that's just going to be equal to the last volatility number I have down here. There it is there, 43.9%. And I'm going to copy that and put it here on the Ethereum one as well, which we can see is actually 57.8%. So again, the current volatility for Ethereum is way higher than Bitcoin's. Bitcoin's at 43.9, Ethereum's at 57.8. We have the information we need now to go and calculate, in order to manage risk, how much capital I want to allocate to Bitcoin in a trade versus Ethereum. And remember, this is all in the spirit of managing risk. There's different strategies to capital allocation, but here we're doing it in terms of managing the risk in how volatile one asset is versus the other. Let's create a new sheet and call it capital. Now let's put in our capital number, the amount that we have to put on, say, a given trade. Here I'm going to just put 100 for $100. And then here, let's move this out a bit. Let's put Bitcoin and Ethereum. Let's put their volatility. And I'll use the latest volatility for the two. So here I'm going to use Bitcoin. You can use whichever you want, whichever makes most sense from the strategy or from your strategy's point of view. But I'll just use the latest. Here's Bitcoin's there. And I'll copy that across for Ethereum because that's just going to be the same cell. We put it in the same place. That's Ethereum there. So there's our 43.8 and our 58% over there. 43.9 and 57.8% volatilities. So one way I could calculate this is just getting the Bitcoin inverse, and the same here for Ethereum. So that just means 1, that's equal to 1 divided by that number. And the same for this one over here. And then what I can do here is just put weighting, and that's going to be equal to that number divided by their total, and the Ethereum number divided by their total as well. So I'm just going to move that along there. And there it is. So this is telling me out of my two assets, I want to put about 56. In fact, let's put this into percentage terms. 56.9% of my capital into Bitcoin and 43.1 into Ethereum. So this here is going to be apportionment, or let's just call that allocation. And in there, I'm going to say 100 times 56.9 and 100 times this one here, which is 43.1. So that's telling me in terms of US dollars, let's go and format that here so that's clear, how much I want to allocate to each asset. That's fine. We can use United States and OK, which means let's call this the factor BTC. I'm going to just say equals that divided by that, which is the same thing, by the way, as just saying this divided by this. And then I could take that there and make that a decimal, just like above. And you can see that I get exactly the same number. So I can just take that Ethereum volatility divided by Bitcoin's, and I'm getting to the same number if I want the factor. Now, what is the factor actually telling me over here? Well, it's saying for every dollar of Ethereum, how much should I wager on Bitcoin? Here it's saying 1.3. So just take whatever number I'm putting on Ethereum and multiply it, in this case, by 1.318. That's how I can then balance out my risk. So given that Ethereum is more volatile than Bitcoin, that's saying here that I want to put more capital into Bitcoin versus Ethereum, because then I can rebalance out that volatility equation between the two assets. And this is a very good example of how to use a GARCH model to, number one, model the volatility, decide what type of volatility you want to use, and then use that for capital allocation to manage risk, which is really useful if you have a trade where one asset is way more volatile than the other, and you want to try to unburden yourself as much as possible from being exposed to that risk. I hope you find this one very useful. And I got to tell you as well, GARCH models, there's a huge rabbit hole to go down here. There's something very interesting known as a DCC GARCH, which is a GARCH model that can output the correlation over time between the two assets, because not only does volatility cluster, but so does correlation. And that's actually something that I'm working on bringing into the upgrades for Crypto Wizards as well, so that people can get that view instantly of the relationships between two assets. Till the next one, take care and talk soon.